it looks like we have who we have for right now. It's a really small group, so feel free to unmute yourself and interrupt and ask questions. If you've got specific scenarios that you're worried about, we're happy to help. And we'll go ahead and get started. Welcome. I'm here. My name is Rebecca Shepard. I'm here with Peter Huckabo, and we are tax attorneys. And we, prior to the pandemic, did a lot of tax controversy, so tax defense with IRS, Comptroller of Maryland, other state agencies in order to help our clients that were kind of on this bubble of viability. Once the pandemic hit, we knew we needed to dig down deep into the CARES Act and make sure that our clients were going to be able to continue to operate their businesses. So we started with PPP. And for those of us who've seen our show before, we did a lot of PPP presentations because those rules kept changing. We worked with EIDL and RRF, the Employee Retention Credit. And now we're trying to actually just holistically advise businesses on how best to get every credit available while also just making some common sense solutions regarding entity structure and things like that. That's it. We're gonna hop right into it. And first we'll start with ERC. I promise we won't take a long time on it, but it is still out there and it's still the most lucrative tax credit that I've ever seen. And so we want to make sure that folks are still thinking about this if they have not claimed yet, or if they're giving advice to their clients, to make sure that that advice is appropriate. You want to make sure that you're not going to be barred by any statutes coming up, possibly saying someone was ineligible when they might have been.
Ron, it's me. Is that what's happening?
I believe so.
All right. Yeah, we are just going to quickly go through ERC before we get into some of the other credits, planning things. The goal here is to give you some other ideas that you can implement with business owners. First, though, ERC's been the biggest thing around, certainly since PPP. And, it came out in the CARES Act. It's been tweaked a couple of times. There's some, interpretive guidance out there from the IRS, but, that leaves quite a bit to be desired. There was a big gap in any sort of statement from the IRS about ERC, and if you guys have been involved in it at all, you realize that the government made it pretty easy to do incorrectly and really hard to do correctly. And finally, in October, they came out with warnings, not too in depth, but just saying some third parties are taking improper positions related to taxpayer eligibility for and computation of the credit. And you read that and you're like, well, duh. But, we just want to run through, certainly if you haven't claimed yet, you ought to, look into it and investigate it and evaluate your own situation. If you have claimed, and worked with, one of these third parties that is doing it incorrectly and doing it easily, you might want to think through, part of tax planning is if there's something that is incorrect, trying to figure out how best to mitigate any issues and resolve it. So I'll throw it back to Rebecca and let her run through, the eligible employer analysis. That's really the hard part, because this isn't something that you click through on a website and answer 4 questions and boom, you're done. So back to you.
Absolutely. I actually had a call the other day with an attorney, and he was saying that his neighbor down the street is doing this. And he was like, and he got D's in high school and didn't go to college. So I appreciate that he's started a business and is being entrepreneurial, but at the same time, I feel more comfortable going with a CPA like you guys, or, a tax attorney. So you'd actually be really surprised to see the qualifications of some of these folks. So what is it? To be an eligible employer, that's step 1 of the analysis. First you have to be eligible, then you can calculate qualified wages. So what is an eligible employer? It's an employer that's carrying on a trade or business during the calendar quarter for which the credit is determined. And method one, this is the simplest method. It's my favorite because it's black and white. I know it's going to be accepted. It's no issues. It's a significant reduction in gross receipts. You do not need to be a lawyer to determine the gross receipt reduction. Gross receipts are less than 50% of the gross receipts for the same quarter and calendar year 2019 in order to be eligible in 2020. And then 2021, they made it, a little bit easier and said, okay, all you need is a 20% decline, 2021 comparatively to 2019. There are alternative reference periods for 2021 that allow for automatic qualification for successive quarters. There's a similar thing in 2020, but the reason we make such a big deal about it in 2021 is because the credit is so much more lucrative in 2021. And in 2020, you might be able to max out, regardless of that successive quarter. But this is something to pay attention to. People make this mistake a lot, like surprisingly a lot, missing that alternative reference period. Now, everyone should just remember that the employee retention credit is a refundable tax credit. There is no means test. There is no assertion that you're making on these returns that the company is in need of this refund. It's whether or not the math works. And if it does, then you're eligible for the credit and you can go ahead and get it. I had a client who had a 20.2% drop in Q2 of 2021. And then in Q3 of 2021 had a 2,000% increase. And to show him and to have him feel comfortable in applying for Q3 of 2021 took a lot of work. And he was an attorney. He just felt like it wasn't the right thing, that it wasn't proper. And that's not the rule. So this is how to calculate the reduction in gross receipts. We tell everyone to do this first because it's like the most straightforward. And then we kind of get into that legal analysis next. So if you don't qualify based on gross receipts, then you look and determine whether or not you had a full or partial suspension of business or trade operations. So the operation of your trade or business is fully or partially suspended during the calendar quarter due to orders from an appropriate governmental authority. So when we say orders, we mean federal, state, local. Foreign orders don't work here. Guidance, like CMS guidance, doesn't work here. Shoulds don't reach the level of an order. Limiting commerce, travel, or group meetings due to the coronavirus disease. So it has to be because of COVID. It has to be due to a governmental order. And your business has to have some sort of restriction or suspension. So the portion of your trade or business is fully or partially suspended. In order to determine if it's enough, it has to be more than nominal, which is a facts and circumstances test. And you're going to be looking at 2019 to determine whether or not that portion of your business that was suspended is more than nominal. So we look at restaurants because it's the easiest example that people can kind of get with. And if your indoor dining operations was more than 10% of your revenue in Q2 of 2019, then you're going to be an eligible employer for Q2 of 2020 because your dining room and indoor dining operations were completely suspended. So it's not as straightforward as the gross receipts test, but it is certainly more straightforward than our next test. Because the analysis is much simpler when operations are closed, but when you reopen, you have to consider modifications that businesses were required to take on. And then you analyze whether or not those modifications have more than a nominal effect on your current ability to provide goods and services. So now, June, July of 2020, that restaurant was allowed to reopen. They're indoor dining, but there's a 50% capacity restriction. There was a 6-foot social distancing restriction. Did those restrictions have more than a nominal effect on its ability to provide goods and services? And that's going to be a case-by-case basis. If anyone is telling you that you're automatically eligible for a certain period of time while you were open and had modifications, they are telling you the wrong thing. They're making something that's pretty complicated overly simple. You have to look at the drive-through sales. You have to look at takeout. What does that mean? And where are you currently in August of 2020? And whether or not those dining restrictions had more than a nominal effect on your ability to provide goods and services. 50% capacity, you can say yes. And then what about 75% capacity? What about 90%? And then it's going to change. You're going to have to keep looking at those circumstances and make a determination of whether or not those restrictions have more than a nominal effect. This is where Peter and I kind of spend a lot of our day, arguing or discussing whether or not a business is going to qualify on that nominal effect test. And back to Peter.
Real quickly, there is a third method of eligibility. It's limited. It's very definitional. So by definition, the business starting as a recovered startup business began operations after February 15th, 2020. If you started February 14th, sorry, you're not a recovery startup business. The other test is that on average, receipts were less than $1 million. I'll talk quickly on another slide about controlled groups, but point is you pull in that analysis as well. Really, this is a credit that's just available for Q3 and Q4 of 2021. It's the only method of eligibility for Q4 of 2021. It's capped at $50,000 per quarter, so a total of $100,000. What is this? It's you took a risk. You started a business during a pandemic. You not only survived to Q3 and Q4, but you actually had employees in Q3 and Q4, and the government's going to reward you for it. Before we move on to the next stuff, there are some special issues. So this is where ERC is built on top of existing tax law. There are issues related to controlled groups of corporations, affiliated service groups that need to be taken into consideration. So what does that mean? You know, whoever you're working with or did this needs to be asking about who owns businesses and what the relationship between businesses are, because for purposes of computing the credit and for certain parts of the analysis here, whether it's a full-time employee analysis or a gross receipts analysis, it really, really matters what the control group is, because it's going to be considered a single employer for purposes of the credit. Not only do you need to know, who owns the businesses, this next bullet point, you need to know who works in the businesses. Majority owners, and not 50%, but 50% plus one. Their wages are not going to be considered qualified wages. But in addition to that, there's deemed owners, and that is generally close family members, but frankly, like all the way down to nieces and nephews, I think, and step relationships matter and in-law relationships matter. There is a safe harbor that if you acquired a business and understanding how to analyze that related to the significant decline in gross receipts. So if that happened, you're going to want to slow down and make sure you work through those issues. The other existing law, so just so everybody knows the due date, this is a date certain. Credits related to 2020 need to be filed on or before April 15th, 2024. Credits related to calendar quarters in 2021, add a year, April 15th, 2025. Then the assessment statute expiration date, again, this is just existing law for quarter 2 2020 through and including quarter 2 2021 is 3 years from the date of filing the original return. What this means is that 2020 calendar quarters, the way the law works is that they are deemed filed the following April 15th. So they were deemed filed April 15th, 2021, add 3 years. The IRS has until April 15th, 2024 to audit those returns. Q1 and Q2 of 2021, same 3-year rule. They have until April 15th, 2025. Congress gave Treasury an additional 2 years for quarter 3 and quarter 4 as part of the American Rescue Plan. That means they have until April 15th, 2027. Keep an eye out. The administration asked Congress to increase the statute of limitations for all of the years by 2 years. I don't know if Congress can get out of their own way to make that happen, but it is at least theoretically possible that they could pass a retroactive law to make that happen. And then just make sure that everybody understands this is generating taxable income. Code section 280 cap C basically says if you get a credit based on wages paid, you lose the deduction for those wages up to the amount of the credit. The regulations under that section require a specific tracing to the wages that generated the credit. And so what's happening here is you've got to go back behind and amend a 2020 or 2021 tax return, income tax return, and pick up tax in those years. I've seen commentators try to say that the tax effect can be picked up in the year of receipt. I don't see any basis for that. I think the regulation is pretty much on point. That is that. We are a small group. If anyone has any questions, either put in the chat or unmute yourself if we have that unlocked. Otherwise, we'll move on to some of the other stuff. I mean, ERC is by far the most lucrative thing out there now. And I'll compare and contrast it a little bit when I talk through the work opportunity tax credit, which is another, frankly, COVID era relief package. It was extended to continue beyond because of the pandemic. So I don't see any questions coming in, so we can move on. So the work opportunity tax credit, I've also heard it called WOTC, is a federal tax credit for hiring and employing individuals from certain targeted group. And we'll go through the 10 or 12 different targeted groups, but the common theme is that historically they have faced significant barriers to employment. This was initially set to expire at the end of 2020. The Relief Act that sort of flipped the ERC on its head, December 27th, 2020.
Can I interrupt you real quick?
Yeah.
Someone just asked about getting ERC through a PEO. So rather than switching gears again later, just kind of entering it up now. And the answer is each PEO is different, and some are much easier to work with and some aren't at all. Every PEO I know has these like internal deadlines where you must submit your calculations by that time, or you're not going to be part of that filing. Like I know Paychex PEO's deadline is today. TriNet had a deadline, had several deadlines in May for quarters of 2021, and they're not going to refile again until December. That's usually the biggest issue that clients have regarding the PEO, is just getting them to file and they're like actually submit the filings, because obviously the PEO doesn't want to file 30 of these things at a time, like every other day. That's basically like the procedure. I don't know if you have any other specific questions, and if you want, you can reach out to me directly. So someone just said we have TriNet, and how does IRS do audits for this? So TriNet's next filing, I think, is in December. TriNet, you can submit your calculations, or my interpretation of the way PEOs are working is they're basically saying you're asserting you're eligible for this credit. So you've had to have somebody work through it for you. Unless I guess it's gross receipts, but someone should work through and make sure that you're an eligible employer, because you're certifying that that's the period that you're eligible for. And then some PEOs will calculate the wages that you've calculated, some won't. The last one we did with TriNet didn't have PPP, so I'm not sure how those offsets would work, but I imagine you could submit your calculations to TriNet directly. Paychecks, we're going back and forth on the numbers because we disagree. So you have still some ability to kind of advocate for yourself and make sure that's being done properly. Audits are very tricky because it's still the PEO's responsibility. So I'm frankly kind of surprised the PEOs are even doing this. without way more due diligence than saying like, okay, you assert you're eligible for this period, because it's going to be their responsibility. I imagine they're going to go after the individuals, like the companies, if there's a change. But that's my 2 cents on PEOs and audits and stuff. Do you have anything you want to add?
The IRS has been very clear that it's the PEO's tax return. The customers of the PEOs have no say in what goes on these returns when they're filed. You can't force them to file. The refunds are going to come back to the PEO. It's between the PEO and their customer, what gets ultimately sent back to them, or even if they send anything back to them. And watch out if the PEO owes taxes, because it's going to get intercepted. This is a mess. So if you're working with a PEO, there's challenges, and I agree with you that everyone is a little bit different.
Like I've seen some actually take the interest, like just take it. Some PEOs are charging huge sums of money, and like TriNet's charging like $300 a return or something. It varies greatly. If you're having issues with TriNet, you feel free to reach out to me directly. I've got some contacts over there. I can maybe help.
I think there was one more that came into the QA, but I'm afraid to click
It's all, I know, it's all the same.
Okay.
There's been 3 questions about this stuff.
Gotcha.
Anything else before we get on to the WOTC? We can always come back to if you guys think of something.
Yeah, that's fine. All right, so WOTC is available for wages paid or incurred now until December 31st, 2025. So you still have a couple of years to do this. Generally, the credit is worth $2,400 per employee, but it can be as high as $9,600 per employee, depending on the characteristics of that employee. So the general rule is it's 40% of qualified wages. Generally, qualified wages are capped at $6,000, but as you see in the case of a qualified veteran with a service-connected disability and at least 6 months of unemployment within 1 year preceding the hiring date, those qualified wages cap out at $24,000. So you get a $9,600 credit. And this is a credit. It is not a refundable credit like ERC is, but it still operates as a credit as opposed to a deduction, and that credit offsets federal tax liability dollar for dollar. Before we get into the mechanics of how you do this, let's just run through targeted groups. I'm happy to share this slide deck if somebody wants it, but I'm not going to go through all the details, but generally, who are the members of these targeted groups that we're looking for? A qualified 4A recipient, a qualified veteran, qualified ex-felon, designated community resident, vocational rehabilitation referral, qualified summer youth employee, qualified SNAP benefit recipient, qualified SSI recipient, long-term family assistance recipient, qualified long-term unemployment recipient. So, if those are folks that you're hiring already, what do you have to do to get this? Because you have to do things in advance. You have to be thoughtful about this. Again, it's not $26,000 per employee, but it's still $2,400 to $9,600. So if all you have to do is a couple more things and you're already hiring them, why not? So the big thing here is that you have to do a pre-screening and obtain a certification from the designated local agency, also known as the state workforce agency. In Maryland, that agency is the Department of Labor. Every state is doing it a little bit differently. It's fairly straightforward to find who your SWA is through a couple of Google searches. But essentially what you're doing is Form 8850 pre-screening notice and certification request for the work opportunity credit. Again, that's a Google away from you. The key here is that on or before the day that the job offer is made, a pre-screening notice must be completed by the job applicant and the employer together. So you're working with the applicant. there are 4 very important dates that you need to memorialize, and you need to make sure they're done in the right order. The date that the applicant gave information about being a member of a targeted group, the date that the applicant was offered the job, the date that the applicant was hired, and the date that the applicant started the job. Then you have basically 28 days to send that into the SWA in the state where the employee works, and it's going to get reviewed and yay or nay. Once you have the certification from the state workforce agency, it's really just a matter of claiming the credit. There is a form 5884 is the work opportunity credit form that rolls up into form 3800, which is a general business credit form. And then ultimately it's claimed on the business's income tax return, however that would otherwise be filed. So if you're a Schedule C on a 1040, you attach it there. If you're a partnership 1065, you attach it there. C Corp 1120, S Corp 1120S. The big thing here, the big contrast with the employee retention credit is that it's not refundable, but you get to carry it back 1 year and then forward 20 years. So in all likelihood, you're going to have an opportunity to enjoy the tax benefit of it. It's just not going to be, money in your pocket like ERC is.
There's a question for you.
Yeah.
We hire a lot of union plumbers who may or may not qualify as veterans. How does that work with union employees?
I'm not aware of any issues with the union. It's really whether or not they qualify under veteran status. So work through those details and understand if they qualify there.
And you can, I'll say this at the end, but we really don't mind, answering questions throughout the week or on the day or whatever. Like, you don't need to, we can talk through your specific situation if there's questions.
You ready?
Yeah, let's do it. So I know some of you are accountants on the call, so I'm going to apologize for my very simplistic view of this. But for those of you that are small businesses and don't necessarily think about when to purchase what, we want to talk to you about how to take expenses in the best way. So there's something called bonus depreciation. There's also called Section 179 expense, and both have different ways to accelerate how to take an expense on your return. So depreciation expenses may be taken the ordinary course to write down the value of an asset over its useful life. Bonus depreciation is a tax incentive that allows a business to immediately deduct a larger percentage of the purchase price of an eligible asset. Bonus depreciation is only applicable to certain business assets, including only property with useful life of 20 years or less. So you couldn't have used it before, that it was not related to somebody that there's some rules and stuff behind this, but otherwise the idea is that you buy something, we would recommend to buy it in before the end of the year. We're in July at this point. So between now and December, don't try to buy things in January. Tax attorneys and accountants like to tell you to deal with taxes later and try to pay as little as you can now. They teach you that in school, but right now you can get 80% bonus depreciation on assets purchased for your business. So certainly things to think about when moving forward as far as what you should be doing. And I would just say, this is what you want to talk about with your CPA. Hey, I've got a big purchase coming up. I think we have one plumber. I'm taking a guess based on the last question, but if you're buying work trucks to go with your business or things like that, this is how you expense it and when to purchase it is something just to be thoughtful about. Next is Section 179 expenses. So Section 179 allows for immediate expense deduction for purchases, but is limited to items such as cars, office equipment, business machinery, and computers. the maximum amount that may be deducted in 2022, which I thought we updated that slide, but we did not. Just making sure you're all paying attention. So last year was $1.1 million. I want to say it went up to like 1.3, but we can double check that. You can email me and I can get you that correct information if you'd like. States also have limits with this that might be smaller than the IRS limitation. So something to think about. I think Maryland has different requirements. And items purchased must be used for business more than 50% of the time. So whether you use 179 or bonus depreciation or however you want to do it, just, be thoughtful about the different rules and how to go about it. The idea is to buy stuff at the end of the year before the new year starts. You can go to the next slide. We have more. Oh, hey, we have 2023 on this slide. Hooray. Section 179 expenses can be more flexible with timing than bonus depreciation rules because a taxpayer can elect to save certain assets for future tax breaks or claim only a portion of the cost and defer the portion for a future tax year. The allowable amount of bonus depreciation is strictly defined, through the prior slide. That's basically it. Bonus depreciation can be for a bigger amount. So be thoughtful in when you buy stuff and how you're going to expense the stuff. Research and development tax credit. This is something that has been around for a while. And it's just something to think about because every business can be eligible for the research and development tax credit. Whereas a lot of people think, you must be like an engineering firm or be, a computer software firm or something like that in order to get the credit. But we know bakers who have gotten it. We know breweries who have gotten it. There's a lot of different ways you can use research and development and qualify, even if you don't have one of these typical businesses. So research and development credit is a federal tax credit available to organizations that invest in qualified research and development activities. The credit provides dollar for dollar cash savings for performing activities related to the development, design, or improvement of products, processes, formulas, or software. Go to the next slide. So it's a 4-pronged test to determine if the business activity qualifies for the R&D credit. One is permitted purpose. So it's an activity intended to develop new or improve business component. So it's going to either improve your function, performance, quality. It could be a product, process, technique. You have to have an elimination of uncertainty. So the activity intended to eliminate technical uncertainty concerning capability, appropriate design, process, or product improvement. You also need to have some sort of process of experimentation, right? That's kind of part of that uncertainty. You need to keep trying to see what is going to get your desired outcome and give you the best product possible. So trying different technologies, several iterations, modeling and simulation, to implement a systematic approach to identify and evaluate different alternatives. And then lastly, it must be technological in nature. So engineering, physics, chemistry, computer science, and other disciplines. But like I said, bakers use chemistry, brewers use chemistry. We know law firms that have created client interfacing software that were able to create a better billing experience for their clients and able to, take advantage of this research and development tax credit.
All right. Should we
Yeah.
pause here for a second, just see if anybody has any other questions? All right, so I just want to make sure that part of tax planning is also being thoughtful about the choice of entity and understanding the tax implications of choosing that entity or choosing, checking a box and electing certain tax treatment. There are many other reasons to choose an entity for non-tax purposes. And I'm not here to go through an exhaustive list of anything along those lines. What I'm more concerned about here is understanding where you get the most tax efficiency. So first of all, the most inefficient and really where you don't want to be is a sole proprietor with no entity in place at all. That's a bad idea for a non-tax purpose, and that's because of liability. So at a minimum, you ought to have a single member LLC, which for federal tax purposes is completely disregarded, but will at least help you shield assets and create something separate from the business owner. But this is pretty tax inefficient because this sole proprietor, single member LLC owner is paying both income tax and self-employment tax. And so you're trading some simplicity, but you are turning around and paying additional tax. Once you get into multiple member situations with partnerships and multiple member LLCs, this can also be pretty tax inefficient, but there are many reasons why you would choose this structure for non-tax purposes, because you can't do what you want to do in a C Corp or an S Corp. So, this ultimately has to do with the relationship between the partner and the business itself. But in this scenario, the partner is paying tax both on guaranteed payments and also on pass-through income. So not as efficient. Then you get into corporations, and there's C corporations and S corporations. C corporations through the TCJA did actually have the tax rate reduced. But at the end of the day, the S Corp, and we'll talk about why, is still, the most tax efficient. C Corps have issues where you have double taxation. So the corporation itself pays tax, and then the individual shareholder pays tax again when dividends are paid out to that shareholder. But there are some fantastic non-recognition provisions in the code related to C Corps. So if you're planning and thoughtful up front, you can take advantage of some pretty significant tax savings during the life cycle of that business and other investments. S Corps, remain the most efficient. In this situation, though, you got to do a little bit more work, and you work for it. So again, this has to do with the relationship between the owner and the corporation. In this situation, it is one of employer. So what does that mean? It means that an S Corp owner needs to be, to the extent they're providing services for the S Corp, on payroll. So you're going to have to set up payroll. There's additional reporting related to payroll. There's taxes related to payroll, FICA. So you can do a little bit more work. The other big thing is that the wages paid needs to be reasonable. What is a reasonable wage? Well, it's trying to understand what is a similarly situated owner in a similar geographic location doing the same type of work going to be paid. I can tell you right now, the answer is not $5,000 a year. So that is definitely a thing to, if you don't know, sit down and work with someone and come up with what is a reasonable salary. Is it $60,000, $70,000, $80,000? The reason that you need to have that reasonable salary is that, unlike a partnership, the way this functionally works is that the pass-through income is subject only to ordinary income tax as opposed to self-employment tax, which creates a significant tax savings as long as you are paying yourself a reasonable salary. So again, there are many non-tax reasons to choose partnership or C Corp, or there's never a reason to choose a sole proprietor with no entity. So there are certain rules about who can own S Corps and those types of things. So there's a lot to work through, but just understand that there are consequences to the choice of entity and the tax structures that you're electing, and to make sure you're thoughtful through that, because it's not this big sexy credit that's going to come at you, but over the years, saving 8 to 10% a year really adds up.
Just really quickly about the reasonable comp, we're starting to see these ERC audits come through, and that is something payroll tax auditors know about. Probably one of the biggest questions I get asked is like, is this gonna make me audited? Am I gonna get an audit because I'm filing for this credit? And obviously, we can never give advice based on audit risk or anything like that. But we explain, if you are audited, it's going to be a payroll tax audit. You're going to be in the payroll tax audit department. And things they can audit are reasonable compensation for S corp owners. They can audit classification of workers. So they're going to look at how you're classifying your workers. Do you have a lot of 1099 independent contractors that are like office managers in your business? That's not a good fact. Things to think about as far as like, what does an audit mean for ERC? And just while we're talking about reasonable compensation, that's something that it could be.
Yep.
So just lastly, I think this is the end. One other thing to think about as far as entity structure and what makes sense. I don't know all the states and what they've done, but the Tax Cuts and Jobs Act impacted blue states much higher than it impacted red states. And that is because certain taxes were limited through the Tax Cuts and Jobs Act. So your Schedule A itemized deductions were capped at $10,000. And, I live in Baltimore City. That is not a lot when you're talking about like a 2-family household and you've got property tax and income tax. So what Maryland did and what other blue states have done is figure out these workarounds for business owners. So W-2 employees don't really get to take advantage of this, but if you own a business, you certainly can. And what they've done is said, okay, well, a pass-through entity is basically you. So what you can do is have your entity pay your state income tax for you. And then, so what will happen is if you have $100,000 in income on your K-1 that has passed through on your S corp, then if you normally had $100,000, instead, if you paid Maryland $10,000 to pay the entity's share of your income tax, now your K-1 shows 90 and you're getting an automatic benefit, like instantly, as far as a reduction of income. And it's a reduction of income on both state and federal. So it's a really great program to use if you haven't already started using it. Most people at this point, I think, have gotten acclimated and started making these elections and making sure that they're getting these, taking these expenses at the entity level. But for those that aren't, it's something to talk to your tax advisor about, something to talk to your CPA about, just to make sure that you're paying through the entity. There's no reason not to. Like there's no downside.
Yep.
That's it. So I always close with the fact that Peter and I have been doing this for a really long time, and we've spent an inordinate amount of time. I mean, especially about the employee retention credit for those of us who are friends with us on LinkedIn, like we apologize. We have spent, hours upon hours upon hours and making sure that we're doing that right. We know about these other things as well, but the employee retention credit specifically, we've really spend, a good chunk of our day, every day, weekends too, on this stuff. So we're basically like Def Leppard in 1987, very similar. And we're never going to be as cool or as relevant as we are right now. And we are more than happy to share this knowledge, because not everyone wants to talk to us about this all the time. So don't feel like you're interrupting us. Don't feel like you're wasting our time. Shoot us an email. We truly don't mind. If you filed with somebody else, that's fine. You are doing this for your clients and you just have a couple questions, that's fine too. We really don't mind, stopping our day to help you make sure that you're doing this the right way. So feel free. And with that, we will close. Thank you.